And by the way, I hear this on CNBC, et cetera, like gold it's gone vertical and you should sell vertical. We're starting to get breakouts. And over the last like 5 months, for example, if you look at what silver's done versus gold, it's beat gold solidly. What we do to measure silver gold, unlike what most people do, we divide 1 ounce of silver to 1 ounce of gold, express it as a percent. So right now, silver's traded at about 1.15% the price of gold. You go back 50 years, and we showed a graph of what was the highest reading each year of that silver divided into gold. Highest monthly close, okay? And 21 of those 50 years, it was at least 2%. Okay. That was almost a norm. In fact, it didn't, in the bull market years, 78, 9, and 80, 2010 and 11, for example.
Yeah.
Silver was up 3.5 to 6% price of gold. Okay. But right now we're coming up off of a low that was just below 1%. And technically, when you examine the spread, which is effectively, it's a price chart. It's the price of silver, price of gold.
Sure.
And we also run momentum of that spread. We're starting to get breakouts. And over the last like 5 months, for example, if you look at what silver's done versus gold, it's beat gold solidly. Okay. And I think that's the onset of a major shift where at minimum, silver's going to gush up to the 2% level again, which is, again, that's not even extraordinary. It's routine. Why aren't we there now? Now, also another comment I'd like to make is, where's gold versus 2011 high? Well, it was 1920, it's 3,700. Okay, no issue about the 2000. Where's copper? A base metal.
Yeah.
It's trading above its 2011 high. So is it outlandish to say that, hey, maybe markets have made a mistake? We know that historically. Markets get overdone. Markets get overdone on the downside. And they sit there and people say, oh, it's garbage. It's no good. And it's a mistake by a lot of investors. And finally, when reality hits, it wakes up in a way that jars everybody. Well, silver's one of those situations. And its spread is arguing it's ready to ramp again. Its price action has begun to indicate that relative to gold. And it's up more in a year than gold is. Even just go back a full year, it's up more. And I think it's going to rampage over its old dual $50 highs, which are ridiculous old notions anyway. They're antique price highs.
Yeah.
And we're only up there for hours, by the way, not weeks or months. And I think this next surge is going to carry us, this is not the top, by the way, into the 60s and 70s, the next surge. And I think it could happen this year.
Wow.
So, and now that's not the end of it. Ultimately, it wouldn't shock me that gold goes to its normal high. And by the way, I hear this on CNBC, et cetera, like gold it's gone vertical and you should sell vertical and buy, gold is not even halfway up in dimension, percent gain. What we saw from 1976 to 1980, an 8-fold move. Or from the 2001 lows to the 2011 high, an 8-fold move. Gold would have to be about $8,500 to just match the dimension, the ratio move of those two prior bull markets, which occurred under circumstances that are far less earth-shaking, globally dramatic than what we're facing right now.
Right.
So gold going to 8,000 would just be, I will say, oh, so what?
Yeah.
Okay. Well, the 2015, December 2015, gold was $1,045. Okay.
Right.
That was its bare low. Okay.
Right.
So you've tripled in a half. Okay. Not 8-fold. Okay. You ask about when does it end and where is it? I have a different view on that. I think that what we're facing in global financial markets, in global institutions, particularly financially related, like central banks, in the nature of money that's put out by government could change. I think so many things are going to change in the next year or so that you're not going to top gold, that it's going to level off and be institutionalized again as money. This government, that government, finally the U.S. probably be the last one to do it, where suddenly it's a gold-backed currency. and it doesn't collapse again because we're back to a gold standard. We got off that with Roosevelt, and then Nixon helped.
Mhm.
Uh, it's only been, 100 years that we've had the Fed, and about that we had Roosevelt, take everybody's gold from them. So it's not like it's forever that you have fiat currencies.
Mhm.
They've been an experiment of one long human lifetime.
Mhm.
And if it doesn't work well, and I think reality is going to demonstrate that, not just here, but elsewhere in the world,
Mhm.
then the public is going to get upset. There's going to be emotion. Politicians will Trends will be destabilized. And I don't mean Trump as a destabilizer. I mean, even he might be destabilized by the new forces, where
Well,
we
God
go
knows. Yeah.
toward, real money again.
Yes.
And
Yes.
all gold is expressing over the eons, decades, is the ongoing decay in the real value of money.
Yep.
Your granddad built a house, cost $4,400.
Mhm.
Today it's 450,000.
Mhm.
Okay, it's because of the decay in the money unit. I don't mean dollar versus yen or euro. I'm talking dollar's real buying power.
Mhm.
Gold simply expresses that. It inhales and it exhales, but it keeps up with that ongoing decay. And I think we're going to be institutionalized. Wouldn't surprise me. Silver as well.
Yeah.
After all, we've had silver standard. Well, if we did a spread also of GDX versus or SIL, the silver miners ETF
Uh-huh.
versus GDX. GDX does contain about 10 silver miners, by the way, so it does have
Mhm.
some in there.
Mhm.
But SIL is breaking out on a spread basis versus GDX. And we're just looking at the spread chart. It's really pretty much matched GDX for the last couple of years. It's held par status. In other words, it dropped from its 2020 highs versus GDX more than GDX did, therefore it underperformed. But over the last couple of years, it's really sort of gone sideways versus GDX in terms of relative gain, et cetera. But it's broken out now. And it looks like it's the same assumption we're operating on with silver versus gold. I think silver is going to outpace gold rapidly. I think
Mhm.
silver miners are now going to be the better place to be among the miners than the gold miners. Not
Mhm.
that the gold miners will do bad, but I think the silver miners will now catch up
Mhm.
because they're as underpriced as silver is. Uh, for instance, GDX is out above its 2011 high.
Mhm.
XAU index out above its 2011 high.
Mhm.
SIL is in the 60s. Its 2011 high was 90.
And
It's to
where's
go
it now?
50. It's in
Yeah.
the mid 60s right now. It
Right.
could go up, nearly 50% just to get to it. So I think there's a lot of catch up that's going to occur. And my personal investments are more emphasized in silver miners, and I even do options.
So those are Michael Oliver's bold predictions for gold and silver as we head into the final stretch of the year. With only a few months left, the big question is, will these targets be hit? And what will it mean for investors and miners alike? One thing's for sure, the precious metals market is heating up, and Michael believes we're just getting started.